Welcome to this summary of The Intelligent Investor by the great Benjamin Graham. But before we begin, please subscribe to our channel and like the video. Now let us continue and delve into the key highlights from this book. Despite past financial crises, there's a safe way to invest: intelligent investing. First introduced by Benjamin Graham in 1949, it emphasizes long-term, low-risk strategies. Learn from Graham's approach and Buffett's success. In this summary, find out why you should ignore market fluctuations, practice with virtual money, and value cheaper stocks. Part 1. Intelligent investors don't rush in. They take time to rationally examine a company's long-term value. Investing offers both lucrative opportunities and risks. Warren Buffett's success underscores this reality. While some investors amass fortunes, many others face significant losses. The key to mitigating risk lies in intelligent investing. Intelligent investors prioritize thorough analysis for steady, safe returns, unlike speculators who chase short-term gains based on market rumors. Intelligent investing focuses on purchasing stocks below their intrinsic value, ensuring a margin of safety akin to prudent shopping habits. While not as thrilling as speculation, intelligent investing prioritizes long-term profitability over excitement. Part 2. Intelligent investing is broken down into 3 principles. Firstly, assess companies' long-term potential and business fundamentals before investing. A stock's value hinges on the company's performance, including its financial structure, management quality, and dividend consistency. Look beyond short-term earnings to understand the company's financial history, identifying undervalued opportunities based on solid records. Secondly, safeguard against significant losses through diversification. Never invest all funds in one stock to mitigate risks associated with unexpected events, such as scandals or market downturns. Lastly, prioritize safe and steady returns over extraordinary profits. Intelligent investors aim to meet personal financial goals rather than outperforming professional traders. Pursuing quick gains can lead to greed and recklessness, undermining long-term success. Part 3. Intelligent investors understand the importance of stock market history. Before investing, prioritize understanding the stock market's history over individual stock performance. Market history reveals its inherent volatility and the inevitability of economic crises like the Wall Street crash of 1929. To weather such events, maintain a diversified portfolio and cultivate psychological resilience. Recognize that markets rebound despite downturns. While crises are unpredictable, historical analysis enhances stability assessment. Once confident in market stability, evaluate company history. Consider the correlation between stock price, earnings, and dividends over the past decade alongside inflation rates to gauge real returns. In trading, historical knowledge is invaluable. Keep it sharp for shrewd decision-making. Part 4. Don't trust the crowd or the market. To grasp the market's dynamics, liken it to a person, Mr. Market, who is unpredictable and prone to mood swings. The market oscillates between excessive optimism and unwarranted pessimism, influenced by events like iPhone releases, which drive prices up irrationally. The intelligent investor remains grounded, resisting herd mentality and Mr. Market's fluctuations. While market highs may seem promising, they often precede overvaluation and future losses. It's human nature to seek patterns, even where none exist, leading investors to misinterpret short-term gains as long-term trends. Understanding these principles sets the stage for practical investment strategies tailored to your style. Part 5. The defensive investor's portfolio should be well-balanced, safe, and very easy to manage. When entering the world of investing, choose a strategy that suits your risk tolerance, defensive or enterprising. For the defensive investor, safety is paramount, achieved through diversification. Allocate investments between high-grade bonds and common stocks, aiming for a balanced split or favoring bonds for greater security. Diversify your stock portfolio across established companies, preferably with at least 10 holdings. To simplify, emulate successful investment funds rather than reinventing the wheel. Seek expert guidance to navigate the complexities of investing effectively. Adhering to these principles ensures prudent investment decisions and eventual rewards. Part 6. Investing is easy when you follow the formula. Once you've selected your investment targets, congratulate yourself as most of the groundwork is done. Determine your regular investment amount and monitor your stocks periodically. Adopt formula investing or dollar cost averaging, where you invest a fixed amount consistently at regular intervals. Automate your investments by committing to a set sum, say $50, and purchasing as many stocks as possible with it. While formula investing simplifies the process and minimizes risk, emotional restraint is necessary. Despite limitations on buying more, periodically review your portfolio's performance, ideally every 6 months, adjusting the stock-bond ratio if needed. Annually consult with a professional to fine-tune your investment strategy. With these steps, you're equipped to embark on your journey as a defensive investor. Subsequent guidance will detail strategies for enterprising investing. Part 7. Enterprising investors start similarly to defensive investors. To excel as an enterprising investor, adopt similar strategies to defensive investors, including diversification between bonds and stocks. While defensive investors typically favor a 50-50 split, enterprising investors allocate more to stocks for higher potential returns, albeit with increased risk. Consulting a financial planner remains crucial for both types of investors, though the enterprising approach views the planner as a collaborative partner rather than a sole guide. In addition to bonds and common stocks, enterprising investors explore riskier, yet potentially lucrative opportunities, such as emerging startups. However, they limit such ventures to a maximum of 10% of their portfolio to mitigate risks associated with market unpredictability. Continuous research and portfolio monitoring are paramount for enterprising investors, acknowledging the unpredictability of the market and the need for protective measures in the face of economic downturns or poor investments. Part 8. The enterprising investor doesn't follow the market's ups and downs. Many investors grapple with the decision to sell stocks during price declines or jump into rising markets. This reactionary trading, driven by fear of losses, is common but risky. Intelligent investors take a different approach. Relying on Mr. Market's fluctuations is perilous. Rapidly climbing stock prices often signal overvaluation or risky investments, reminiscent of the U.S. housing bubble. Enterprising investors capitalize on low markets and divest in high ones. Regularly assess your portfolio, scrutinizing company management and financial health. Sell overrated stocks whose prices detach from intrinsic value before they crash. Conversely, seize opportunities in low markets, as Yahoo! Incorporated did in 2002 with its purchase of Inktomi Corp. At a bargain price of $1.65 per share, following a steep decline from an overrated $231.625 per share. Part 9. The enterprising investor has the chance to find real bargains. Becoming an enterprising investor may seem daunting, but the effort is worthwhile, as it often leads to discovering the best bargains. Start your journey by virtually tracking and selecting stocks for a year. Numerous websites offer virtual investment platforms where you can practice stock selection and monitoring, helping temper unrealistic expectations and refine investment skills. After this virtual experience, you'll be prepared to hunt for bargains, particularly in undervalued company stocks. Such opportunities often arise when companies face temporary challenges, causing stock prices to drop despite their long-term potential. For instance, consider Enterprise B, a reputable competitor in the refrigerator market experiencing a temporary production error. Investors panic, causing stock prices to plummet. However, savvy investors recognize this as an opportunity to acquire undervalued stocks with strong long-term prospects. Identifying bargains requires practice, making the virtual experience invaluable. Success in the virtual realm indicates readiness for real-world investing challenges. Whether you prefer a cautious approach or aspire to be more entrepreneurial, adopting the mindset of the intelligent investor is paramount when dealing with stocks. By adhering to the principles outlined in this guide, you can transform your investments into consistent and reliable profits, albeit modest ones. Lastly, thank you for watching this video, and please like the video if you enjoyed it. Also, let us know what you rate this book in the comment section down below. and what book we should review next.